Hey guys, welcome back to the Value Investor Show. Adobe is reporting their Q4 earnings tomorrow after market close. And here's what you need to know, with many people asking if Adobe is a buy before the results. So for today, I want to go through the current market dynamics. I want to go through Adobe's historical results versus expectations. Have they met, have they missed, or have they beat the last results? I want to go through the current expectations. So what is currently expected by Wall Street for Adobe in Q4, go through the fundamentals as well as some metrics in terms of how Adobe is performing versus the current overall market and their competitors, and go through the intrinsic value and final thoughts about whether I'm buying or whether I'm selling Adobe before and after closure. Now, the fear index is just unreliable. To tell you the truth, this is the one metric that you shouldn't take into consideration. I mean, now we're back in fear. We used to be at extreme fear for the longest time. We're at extreme fear for 2-3 weeks. Now we're back to fear, but the truth is the overall market is thriving. However, I think there is one metric that really shows the truth, and that is the volatility index, the VIX, which actually shows volatility. As you can see, we did see very high volatility during the 20th of November, and that's when there was a big sell in stocks. And since then, that volatility index has then calmed down, and since then we have been seeing better performance for stocks. Higher volatility usually means more selling. It could also mean more buying, but it's usually selling. Now, before we dive into Adobe, I would like to thank you for watching this video. I would like to thank you for the support. Actually, 72% of you watching the video are actually not subscribed. So if some of you can subscribe, I can hit my 4,000 subscribers target by the end of the year. So if you're one of those 5 that would like to subscribe, it will help me massively to get into my target. Now let's get right into it. Adobe is down 28% over the last 5 years, and it's down 50% from its all-time high in 2021. And that has been happening while revenues almost doubled since then, since the last 5 years, with a forecast of an EPS of roughly $23.4, which that means that the forward year plus 1 P ratio of Adobe is a staggering 13 PE ratio. The company is now down 22% year to date, and the current P ratio of the company is 21. In fact, Adobe was trading at roughly $320 just 1 week ago, and is now back to almost $350, so up roughly 7% from that low. Apart from Deckers Corporation, which is a company that I have been covering thoroughly the past few weeks and months, I truly think that Adobe is the next best in terms of a hugely hated company that is heavily mispriced. I've covered United Health Group, which is a company that has fairly rebounded over the last few months. I have covered Meta, I have covered Google, which are companies that I have invested in, and more than double my initial investment. And now I'm covering Adobe because I still think that the valuation makes no sense. I think there are a few risks that some people are talking about, but I also think that those risks can become catalysts. And I do believe that everyone in the future, in the next 12 to 24 months, will say, I wish I invested in Adobe at $320, with many already saying that. And I have covered Adobe thoroughly in one of my last videos, which also was well perceived by you guys. I would urge you to have a look if you haven't already, but I will cover different things in this video. I would also urge you to follow me on X, because I do post daily updates on my buys, on my sells, and what I think about stocks on real time. So if you would like to keep up with what I'm doing, just follow me on X at the Value Invest Show. Now, since Adobe moved to a subscription model somewhere here, the company has basically become a cash flow machine. In fact, since mid-2015, revenue has increased sequentially in 39 out of 40 quarters. I mean, just think about that for a second. Out of 40 quarters, 39 quarters of those, Adobe has seen an uptick in revenue. And actually, since the release of ChatGPT, since the AI will disrupt Adobe narrative, Adobe has seen zero pressure on margins and revenues, and continues to hit all-time highs every single quarter. So until now, the AI will disrupt Adobe narrative has yet to impact Adobe. Now, over the last 10 years, over the last 40 quarters, Adobe missed EPS expectations only 2 times. Now, talk about consistency, because this company has been consistent ever since 2015, beating EPS every single or almost every single time. Now, with the Q4 just around the quarter, I believe that tomorrow is one of the most important quarters, as the management can basically set the tone for the rest of the year. Adobe is scheduled to announce their Q4 earnings results on Wednesday, December 10th, after market close. Wall Street on average expects the semiconductor company to post a quarterly EPS of $5.4, which is up 12.3% year on year, and revenue of $6.11 billion, which is up 8.9% year on year. Adobe also in last quarter raised its fiscal 2025 revenue and profit forecast, citing strong demand for its design software and growing AI monetization. For the fourth quarter, Adobe expects revenue of between $6.08 billion and $6.13 billion, and sees adjusted EPS of between $5.35 and $5.4. The company delivered third quarter results above expectations. Stifel analysts also believe that Adobe has improved its positioning and messaging around Gen AI, and will cover Stifel in the coming slides. And I think there are some really key takeaways from their report that was released yesterday. Now, Adobe's decision to remove digital media annual recurring revenue growth as a metric next year and replace it with total annual recurring revenue is a sign of moderating growth, Citibank said. Over the last 2 years, Adobe has beaten EPS estimates 100% of the time and has beaten revenue estimates 100% of the time. Over the last 3 months, EPS estimates have seen 26 upward revisions and 1 downward. Revenue estimates have seen 21 upward revisions and 3 downward. But since the start of the year, Adobe shares have fallen over 23% compared to the 16% rise in the broader S&P 500 index. So Wall Street has been raising their guidance for Adobe consistently over 26 times for the EPS, yet Wall Street is selling heavily and have been selling for the last 2, 3, 4 years. My Q4 expectation is the following. I expect Adobe to double beat earnings and present better than anticipated guidance for forward year 26. So that will mean more than 9% revenue growth for forward year 26 and roughly around 13% growth in EPS for forward year 26. If that happens, my hope, my belief is that we'll now finally see some more momentum moving forward. And this is actually what happened for Adobe last quarter when the company beat revenue and EPS guidance. We did see the company up 5.8% on intraday trading. However, all those gains have already been erased, with the company now trading roughly at $345. Now, Stifel lowered their price target, but they have maintained a buy rating. On the contrary, TD Cowen maintained their price target of $420 and kept a hold rating. So both these reports came out yesterday, with Stifel also having their price target of $450, which means that both agencies actually see more upside for Adobe than downside. So Stifel came up with a report about how AI positioning is positively evolving. I won't go through the whole report, but I will go through the important bits, which is, first of all, from a financials perspective, Stifel expects revenue to increase 9.6% in 2026 and 9% in 2027. They also expect EPS to grow at 13% in 2026 and 12% in 2027. So that means that the forward year plus 1 P ratio of Adobe is 13.4 and forward year plus 2 of Adobe is 11.8. So overall, Stifel does expect Adobe to over deliver and is expecting and does think that Adobe is currently undervalued. Now, the summary from the report was the following. We're highlighting Adobe ahead of the fourth quarter of 2025 results, as we believe the company has made positive strides over the past year, particularly at Max in October, improving its positioning in and messaging around generative AI. It's no secret that a key overhang for the stock has been the belief that AI will be a disruptive force to creative departments, making creators more efficient by orders of magnitude and shrinking the number of addressable seats over time. By positioning itself as the Switzerland in the market and a central Gen AI hub where creatives can test, leverage, and pay for third-party model usage, we see a clearer path for Adobe to benefit from widespread AI adoption in creation versus a year ago. Admittedly, catalysts to quickly turn sentiment around are foggy, but we believe we remain in the early days of a critical and successful AI-induced strategy pivot at Adobe. This is very important because this is something that I have also covered thoroughly. The main risk is that not only AI will disrupt Adobe at its core and will essentially make the programs that Adobe offer obsolete, but the fact that AI will basically disrupt the number of seats. So for example, a creative agency that has 100 people will no longer need 100 people, but rather they will need 10 people. But what this report is saying is that Adobe is now positioning itself as the Switzerland in the market, saying that Adobe is basically a monopoly, is basically positioning itself as best in class in the market, and it's using their Gen AI hub to allow their creatives to test, to leverage, and to pay for that third-party model usage. And now as Adobe is setting themselves up for success with AI, they view this strategic pivot by Adobe as a very successful catalyst, as a potential very successful catalyst that will drive further revenue, EPS, and further margin growth for the business. Now, if we actually look at Adobe in terms of metrics versus their competition, I think there are a few that really position Adobe amongst the best in the market. And that is, for example, the price to sales ratio, the price to book ratio, the net margin, as well as return on equity, return of assets, and even the P ratio, which are among the best in the market. We're talking 90% plus percentile. So that shows that Adobe is truly a cash cow machine. It truly has a moat, and Adobe has been one of the best performers, financially speaking, in the overall market, in the technology sector, and in the software infrastructure sector. Now, in terms of valuation, I won't go through all three scenarios, the bear, the base, and the bull case, but I'll only go through the base case scenario because I have already covered the bear case and the bull case in my previous video. And for the base case, I'm assuming 9% revenue growth, 11% net income growth, and 11% free cash flow growth at a P ratio of 20, which I believe is fair. And I have read your comments, guys. I do believe that 20 P ratio is fair based on the historical P ratio, because under normal circumstances where a company, a software company, is growing at this growth metrics, I think that a 20 P ratio is a fair assumption to be made. The current P ratio is lower. The current forward P ratio is lower because there is a lot of fear and uncertainty around Adobe. But I believe that if Adobe continues to grow at this rate over the next 5 years, a 20 P ratio is fair. Now, with those assumptions that I'm just pointing out, I have to say that these are lower than the current report that we just showcased from Stifel. I basically even have lower expectations than what Wall Street has. And I'm only doing this because I want to show you guys that even with lower expectations of what Wall Street currently thinks, there's still a huge margin of safety. And under my assumptions, the profit margin is expected to increase from 29% to 32% in 2030, which I believe is also fair. Now, if we look at the base case scenario, based on those assumptions, the intrinsic value with the DCF method is currently at $558, and with the EPS method is $484. So that gives me a margin of safety of almost 30% with the EPS method and 38% or almost 40% with the DCF method. Now, it's less than my target of safety of 50%, but I have to say that I do believe that Adobe is heavily mispriced. I do think that it's still undervalued. And in terms of what I'm doing next is I'm currently staying idle. I am not buying more. But if there is a scenario tomorrow where Adobe double beats estimates, the management provides an outlook for next year that is satisfactory, and then we see a sell in the stock price that drives the price from $345 to even $320, $310, I would heavily load on Adobe. That is everything for today. As always, thank you so much for watching. I really hope you enjoy this free research, free videos that I do for you guys. Subscribe to keep up with the next few videos, and I'll see you guys in the next one.